I always get the number confused. I always forget if it's 10,000 or if it's 100,000. But anthropologists are very clear that the human brain is the exact same size it was 10,000 years ago, or maybe the number is 100,000 years ago. But regardless of which one it is, let's just go with we have the exact same brain from a Homo sapien point of view from 100 years ago. So that I am a gazillion percent sure that our brain processing power is exactly the same it is today as it was 100 years ago. What I want to do is talk about how the fact that this brain processing power of ours hasn't changed and how it affects us. Hey everybody, this is RC Peck, and this is my weekend podcast. Um, things are a little different today. Um, I don't know how the recording is sounding, but I'm actually sitting in my car because the internet is down. So I'm getting this done to get this out to you as I want to connect with you each week. So stick with me in case it does sound a little weird. But really, what I want to talk to you about and the theme I want to talk to you about is distraction. And people often talk about what is your edge? What is your edge? What is your edge? I think I brought this up last week, and most people think getting an edge is getting better data or faster data. And I said last week, it was either last week or the week before, that it's not data, it's point of view. And what I meant by that was, or as much as I meant point of view, I meant how do you eliminate, how do you delete, how do you get rid of all of this noise, all of this distraction? And so I started with anthropologists is because, and the size of the human brain is the amount of information that is being thrown at us daily has gone up exponentially. You know Moore's law, which says the processing power of a computer will double every 18 months. Well, there should be another law, and maybe there is another law around the amount of data that is getting thrown at us and how it is doubling also. And it's probably not doubling every 18 months, it's probably doubling even faster. And this is very true with the Pick of the Month newsletter industry that is absolutely throwing so much information at you. And so what I want to do is I think it's 6 charts. I'm going from memory. I want to show you, but I want to show you how you can look at the data and you can have a way of filtering out the distraction, because our brain has not changed the way it processes information for sure over the last 100 years, but the amount of information that is getting thrown at our brain has gone up 100 times, 1,000 times, 10,000 times. It's gone up significantly. So this price chart here, this is just showing you the last 7 bull markets in gold. And the current one is the red one, starting from January of 2016 to today. I'm not going to get into the details of what defines a bull market or not a bull market in gold, but this data goes back about 80 plus years. So the only point I wanted to show you is if we are in fact starting the next bull run in gold, again using Barron's definition, I simply want to point out that there'll be plenty of time to get on board if in fact it is. So it's kind of nice just to see this piece of data and go, okay, look, if in fact gold's going to take off, it's very likely that we have many more months and quarters and even years to get on. But of course, looking at the data and knowing what to look at and what not to look at is super important. I'm not saying jump in, back up the truck. I'm simply pointing out that these gold runs can run for a while. The second thing I want to show you was this is a commodities to stock ratio. You know I love looking at ratios. So this ratio goes back to 1970. So it's been around for a while. We have 47 years of data. And I want to just point out 2 things on this price chart. One, we're at one of those points where commodities has greatly underperformed the stock market on a ratio, on a relative basis, just like it bottomed here in about 98, just like it bottomed here in around, it's probably around 71, 72. Now gold bottomed, gold went from 35 an ounce to 850 an ounce in the 80s. Gold bottomed at about $250 in 2000, and gold today is quote unquote flirting with 1300. But again, this is a relative comparison with commodities to stocks, and it's just kind of shown, hey, we're at one of those extremes again. In fact, the extreme today has never been as extreme as it has going back to 1970. And again, that just shows us, and I'm talking about gold. Gold is a commodity. It's also a non-fiat currency. But there could be a turning point happening soon. This point right here, now this doesn't necessarily have to do with gold, and this podcast to you isn't meant to be a gold podcast, but I simply wanted to point out where the global growth is going to come from in the next 2 years. And if you look, the big red one's China, and then you got India. So those are two pretty big ones right there. If you add those up, you're getting close to 45%. Certainly if you add in Indonesia. And just look, the US will still do well, but only about 18%, and the EU only about 8%. So a lot of the global growth is still going to come, not, I shouldn't say still, I mean, it has been coming from China and India, but it will continue to come from China and India. And where growth is typically stock markets follow. That hasn't been true with emerging markets and China, but things could be changing soon. So if you are not living in China or India, meaning you have that local domestic bias, then you may want to be thinking about looking at those parts of the world. Hey, we are the yellow line on this price chart. This is economic expansion in the U.S., the longest economic expansions since 1960, and this covers 1, 2, 3, 4, 5, 6. So 6 economic expansions. We're the yellow line right here. So we could expand longer, right? We could go and compete with the blue length or the green length. The point is not necessarily to show you the length, though it's good to know that we can expand for longer, but to show you that this is the lowest sloping or flattest sloping expansion since 1960, right? So the last 57 years. So the way we're expanding is at a very slow growth rate. Not the end of the world, but there's not a lot of cushion if things do go sideways. And then I've shown this before, but this is the it's the Shiller 10 PE ratio. So it's a cyclically adjusted price to earnings ratio. And I simply just want to point out that we're today flirting with about 30, which is still below the 1929 crash and still below the dot-com crash, but we are above the 2008 valuation. And generally speaking, you don't want to be comparing things to the dot-com crash or the 1929 crash, but really that's where we are today in the cyclically adjusted price to earnings ratio, which is the one that I track because it is able to smooth out a lot of noise. So again, we look to the price charts because the price charts don't lie to us. And if they do lie to us, they're the one thing that's least likely to lie to us. I wanted to show you this. This is unemployment in the US and how low it is right now. And what I just thought was interesting, and we are right, what I thought was interesting was how low unemployment was before the 2008 crash and how low unemployment was before the 2000 crash. I thought that interesting. And back here, there was the 1987, which was the worst one-day market correction or crash ever. So I just thought it was interesting that how low the unemployment rate is down here, or how it's fallen down to levels where we haven't seen since 2008, 2000, and 1987. Again, 3 dates you probably don't want to be comparing yourself to necessarily if you're a buy and forget or a buy and hold. So I've given you 6 pieces of data. I sometimes hesitate to give too much. I come across a lot of interesting information, and I kind of think about how to curate it best for you. But in regards to these 6 price charts, and they're not price charts, but 6 pieces of data, in order to eliminate the distraction or greatly diminish it, you want to move to the price charts and look at the price charts and have the price charts tell you where the best location is, what the best size is, what's the best type stock. Because when you can know those 3 and even precede that with should we even be in the stock market, then that's really optimizing that most important piece of data in your investment world, right? You don't want to optimize what's the best stock to buy in the consumer staples sector if you shouldn't even be in consumer staples or shouldn't even be in U.S. domestic or shouldn't even be in the stock market. That's a distraction. You want to optimize the major critical things in your investment world, which is, should we even be in the stock market? And if yes, where? And if we shouldn't be in the stock market, what's that major asset class, that major type that we should be in? And so that's the takeaway. The takeaway is that distraction is very expensive. And that's why I rail against the pick of the month newsletter industry, because they are a pick of the hour. They are a distraction of the hour, distraction of the day newsletter industry. And it's that distraction that is eliminating your edge. Even at the same time, they're telling you, no, this is the edge. You have to know all this stuff. But it is such a distraction and it is so expensive. The stories are expensive, the hype is expensive, and those end of the world. I mean, really, the end of the world is the story and the hype together. But those distractions are very expensive. And when you can optimize the critical 1, 2, or 3 pieces of data, you can just forget about the rest of the information because it doesn't matter. That's literally the trivial information. Thanks so much, guys, for being in my world. This is just another step in helping you protect your portfolio and your future. Until next time, this is RC Peck.